Should you focus on quick gains or play the long game? Let's explore the difference between long-term and short-term investments. Long-term investments such as stocks, real estate or retirement accounts focus on sustained growth over years or decades. These investments benefit from compound interest and the ability to weather market volatility. For instance, the stock market has historically provided an average annual return of 7% over the long term. In contrast, short-term investments like savings accounts, certificates of deposit, or money market funds prioritize liquidity and lower risk. These are ideal for saving for near-term goals, such as a vacation or emergency fund. However, short-term gains often come with lower returns. The right strategy depends on your financial goals. A balanced approach might include a mix of both. For example, allocate a portion of your funds to a high-interest savings account for immediate needs while investing the rest in stocks or ETFs for the long haul.